In 1985, a starter home, a small three-bedroom, one-bathroom house in a decent neighborhood, cost about $80,000. A public school teacher making $23,000 per year could afford it. That same type of house today, if you can even find it, costs about $350,000. But here's the problem. That house often doesn't exist anymore. It was either bought by an investor and rented out, torn down and replaced with a much larger, expensive home, or renovated beyond what a first-time buyer can afford. Meanwhile, teachers today make about $65,000 on average, which sounds like more until you realize housing prices went up over 4 times, while teacher salaries only went up about 3 times. Today, I'm going to walk you through exactly what happened to starter homes, why they've largely disappeared from the market, and what this means for people trying to buy their first house. Let's start by defining what we mean by a starter home and what they looked like in the 1980s. A starter home was typically a modest house that a young couple or single person with a middle-class job could afford as their first home purchase. These were usually about 1,000 to 1,200 square feet, 3 bedrooms, 1 bathroom, maybe 1.5, built between the 1940s and 1970s, simple construction, minimal luxury features, located in working-class or lower-middle-class neighborhoods, priced at the lower end of the local housing market. In 1985, the median home price in America was about $75,000. Starter homes in many markets were in the $60,000 to $90,000 range. Let's use $80,000 as our example. Now let's look at what a typical middle-class worker earned. A public school teacher with a few years of experience made about $23,000 per year. A registered nurse made about $21,000. A police officer made about $25,000. An electrician or plumber made about $28,000. At $80,000, a starter home cost about 3.5 times a teacher's annual salary. With a 10% down payment of $8,000 and a mortgage interest rate of about 11%, rates were high in the mid-1980s, the monthly payment would be around $750, which was about 39% of a teacher's gross monthly income before taxes. This was tight but achievable, especially for a couple where both partners worked. It meant living carefully, not a lot of financial cushion, but homeownership was realistically within reach for people with stable middle-class jobs. Over the past 40 years, starter homes have largely disappeared from many housing markets. This happened through several interconnected trends. Trend number 1. Investors bought them as rentals. Starting in the 1980s and accelerating significantly after the 2008 housing crisis, individual investors and eventually large investment companies began buying up starter homes to use as rental properties. After the 2008 crash, when home prices dropped and foreclosures flooded the market, investors saw an opportunity. Companies with access to capital bought thousands of foreclosed homes at discounted prices. Single-family homes that had been owner-occupied became rental properties. This trend continued even as prices recovered. Investors found that single-family homes in working-class neighborhoods could generate steady rental income. The homes that would have been perfect starter homes for first-time buyers became rental properties instead. When starter homes are removed from the for-sale market and converted to rentals, there are fewer options available for people trying to buy their first home. This reduced supply pushes up prices on the remaining starter homes. Trend number 2. Teardowns and McMansions. In many neighborhoods, particularly in areas that became more desirable over time, starter homes were torn down and replaced with much larger, more expensive houses. A developer or investor would buy an $80,000 starter home on a decent-sized lot in an improving neighborhood. They'd demolish it and build a new house that was 2 or 3 times larger with luxury finishes and sell it for $300,000 to $500,000 or more. From a business perspective, this makes sense. The land has value, and building a larger, more expensive home generates more profit per lot. But it removes affordable housing from the market and replaces it with housing that serves a different, wealthier market segment. This is particularly common in neighborhoods close to city centers or in areas with good schools, exactly the places where first-time buyers want to live. Trend number 3, renovation and flipping. Another pattern is renovation and flipping. Investors buy starter homes, renovate them extensively, and sell them at much higher prices. A house that could have sold for $120,000 as is gets $50,000 in renovations and sells for $220,000. The renovated house is nicer, certainly, but it's also no longer affordable to the first-time buyer who could have afforded the $120,000 version with some cosmetic updates they did themselves over time. Home improvement television shows popularized this model. Flip or Flop, Fixer Upper, and similar shows made house flipping seem like an accessible investment strategy. More people entered the market looking for houses to flip, which increased competition for starter homes and drove up prices. Trend number 4, zoning and development patterns. New construction has largely stopped building the kinds of homes that served as starter homes in previous generations. Modern housing developments tend to build larger homes because the profit margins are better. Zoning regulations in many areas require larger lot sizes, which increases land costs per home. Builder codes have become more complex, adding to construction costs. Builder preference and market demand from wealthier buyers shifted toward larger homes with more features. The median size of a newly built home was about 1,500 square feet in 1985. Today, it's about 2,400 square feet. Builders aren't constructing the small, simple homes that could serve as affordable starter homes. Trend number 5, increasing land values. As metro areas grew and desirable suburbs expanded, land values increased significantly. A lot that cost $15,000 in 1985 might be worth $150,000 today in the same location, even before considering any structure on it. When land is expensive, it doesn't make economic sense to build or maintain a small, modest home on it. The incentive is to maximize the value by building the largest, most expensive home that the local market will support. Now, let's compare what a teacher or nurse could afford then versus now, using the same types of jobs to show how purchasing power changed. 1985, public school teacher. Annual salary $23,000. Starter home price $80,000. Home price to income ratio 3.5x. Down payment 10%, $8,000. Saving 10% of gross income annually, $2,300 per year. Time to save down payment, 3.5 years. Monthly mortgage payment, 11% interest, 30 years, about $750. Percentage of gross monthly income, 39%. Tight but achievable for a single teacher, more comfortable for a dual income couple. 2025, public school teacher. Annual salary $65,000, national average. Comparable starter home, if available, $350,000. Home price to income ratio 5.4x. Down payment 10%, $35,000. Saving 10% of gross income annually, $6,500 per year. Time to save down payment 5.4 years. Monthly mortgage payment, 7% interest, 30 years, about $2,100. Percentage of gross monthly income, 39%. Wait, the percentage is the same? Yes, but there's a crucial difference. In 1985, the teacher could find an $80,000 starter home. In 2025, finding a $350,000 home that a first-time buyer can actually purchase is much harder because they've largely disappeared from the market. And the down payment, while the same percentage of income, takes longer to save in real terms because housing prices are rising faster than savings can accumulate. The real comparison, what's actually available? Here's where it gets challenging. In 1985, that $80,000 starter home existed in most markets. In 2025, the equivalent homes often literally don't exist anymore. They were torn down, converted to rentals, or renovated into homes that cost $500,000 or more.
What is available to a first-time buyer in many markets are condos or townhouses, which have HOA fees adding $200 to $500 per month on top of the mortgage, or homes farther from job centers, requiring longer commutes, or homes in neighborhoods with underperforming schools or higher crime rates, or homes that need significant repairs that first-time buyers often can't afford to make. The 3-bedroom, 1-bathroom, simple but decent starter home in a working-class neighborhood with reasonable schools, the house that was common in 1985, is largely gone.
This pattern varies significantly by location, which tells us something about the dynamics at play. In expensive coastal markets, San Francisco, Los Angeles, Boston, Seattle, New York, the starter home effectively doesn't exist at any price a middle-class worker can afford. What might have been a starter home is now worth $800,000 to over $1 million, far beyond the reach of a teacher or nurse. In these markets, even a modest condo might cost $400,000 to $600,000. The idea of a young teacher buying a home in the city where they teach has become largely fantasy. In some Midwest and Southern markets, starter homes still exist at more affordable price points. A teacher in parts of Ohio, Indiana, or Alabama might still find a livable starter home for $150,000 to $200,000. It's more expensive relative to income than 1985, but it's achievable. But even in these more affordable markets, the trend is toward fewer available starter homes as investors buy them up, and as any homes in decent neighborhoods get renovated beyond starter home price points. The geographic variation means that career choices increasingly need to factor in housing costs. A teacher in San Francisco makes more on paper than a teacher in Indianapolis, but the San Francisco teacher has virtually no path to home ownership, while the Indianapolis teacher might. The disappearance of starter homes creates several cascading effects on the housing market and society more broadly. First-time buyers priced out. When entry-level homes aren't available, first-time buyers either can't buy at all or have to stretch far beyond what's financially comfortable. This means higher debt burdens, less financial stability, and increased vulnerability to job loss or economic downturns. Some first-time buyers take on longer commutes to find affordable homes, trading time and transportation costs for lower housing costs. Others delay homeownership by years or a decade, spending those years renting and not building equity. Delayed life milestones. Homeownership has traditionally been connected to other life milestones. People often think of buying a home as something you do before having children, both because you want stability and space for a family and because qualifying for a mortgage becomes harder when you're supporting children. When homeownership is delayed, these other milestones often get delayed too. People have children later or decide not to have children at all because they don't feel financially established enough. Wealth-building opportunity gap. Homeownership is the primary wealth-building tool for most American families. When starter homes disappear, people who would have bought homes in their 20s and built equity over decades miss out on that wealth accumulation. Meanwhile, investors who bought those homes as rentals build wealth through rental income and property appreciation. The wealth gap grows between those who own property and those who don't. Rental market pressure. When people who would prefer to buy can't find affordable homes, they remain in the rental market longer. This sustained demand keeps rental prices high, as we've discussed in previous videos. Renters in their 30s and 40s, who would traditionally be homeowners by that age, are competing with younger renters for available rental properties, keeping the entire rental market tight and expensive. Several structural changes in the economy and housing market explain why this happened. Housing became seen as an investment asset class rather than primarily as shelter. This shift attracted more investor capital into housing markets, particularly into the kind of affordable homes that offer good rental yields. Wage growth stagnated for middle-income workers, while costs in other areas, education, healthcare, childcare, rose significantly. This meant less purchasing power available for housing, even as housing costs increased. Lending standards tightened after the 2008 crisis, making it harder for marginal first-time buyers to qualify for mortgages. This ironically helped investors, who often paid cash, to compete more effectively for properties. Land use regulations and building restrictions limited new housing construction in many desirable areas, constraining supply while demand continued to grow.
These structural factors combined to create a market where starter homes that do still exist often get bought quickly by investors or by buyers with family financial support, rather than by young people buying on their own earnings alone. Starter homes that cost $80,000 in 1985 and were within the reach of a teacher or nurse making $23,000 have largely disappeared. They've been bought by investors and converted to rentals, torn down and replaced with larger expensive homes, or renovated beyond what first-time buyers can afford. Meanwhile, the equivalent homes today cost $350,000 or more, and teachers making $65,000 find that even with higher nominal salaries, the math doesn't work the way it did. This isn't about whether these changes were intentional or who to blame. It's about understanding how a combination of market forces, investment patterns, zoning regulations, and economic shifts created a housing market where the entry point that existed for previous generations no longer exists for many young people today. Understanding these dynamics helps make sense of why home ownership feels out of reach for many people with stable middle-class jobs, and why the path to home ownership looks so different now than it did 40 years ago. If you found this analysis helpful, share it with someone navigating the housing market. Leave a comment about what starter homes cost in your area or your experience trying to buy, and subscribe for more videos examining how economic pathways have evolved. I'll see you in the next one.